Historically, September is the worst month of the year for markets, but will that be the same in 2024? With the US election, the Federal Reserve about to do a rate cut, and of course, a bit of a sell-off post Nvidia earnings, what's in store for these markets next? Will we get gap fills and bounces, or are we going back down to the lows we were at just a few weeks ago? Well, a lot of it comes back to some amazing data that we'll be sharing in today's video, but also Tom Lee has something to say about Nvidia earnings. What is it? Let's take a look together right now as we cover stocks, commodities, and cryptos moving forward. There's some amazing data. Stick around. Let's go through it together. Well, welcome back everyone to The Daily Show. My name's Tom, and in today's video, we need to talk about markets right now because the data coming through is absolutely phenomenal when it comes to September. And as always, we've got some of the latest here. We will go through, of course, the key levels for all the markets, including some amazing moves over the last 24 hours. Congratulations to oil bulls in particular. What a fantastic replicable zone. But let's get into the stats for September for markets. You may be familiar with the fact that September is well known to have a little bit of a shaky start, but still pretty good. And then at the end to see sell-offs. You can see here the last 50 years, the last 20 years, and in particular the last 10 years having this really pronounced rally into dump into the end of the month. Now, will it be the same? We've been making videos like this for many years. Well, I think 2024 might be the most unique one, as we have been hitting this stat now for quite a few years, but it might look a little bit different. And I post a lot of these things over on our X account, so follow in the links in the description down below because we do have some really phenomenal charts there that I think you might want to save onto your computer. This is one of them. Of course, the Federal Reserve is doing a rate cut. We know they're doing it, they've signaled it already, and we also know that the market structure coming into this rate cut and more importantly, leaving the rate cut will be important. Will we see a recession? Are we already in a recession? A lot of people are speculating on that with yield uninversion becoming a thing moving forward. But basically speaking, we are looking for the market structure post the cut environment. Will we have a market that goes up and looks pretty strong, or are we going to have a market that starts to go sideways and weaken off? If we do see the sideways and weakening market, that points towards a recession imminently. And of course, we need to be kind of terrified of that because, as we know, a recession nowadays will probably mean markets could fall upwards of 30 to even 50 or 60%. That is the reality, and that's something we have to be aware of. The Fed rate cutting cycles tend to lead to above average returns. So of course, if you're selecting the data and you're going through all of the cut cycles since 1929, well, you'll notice that in general, most of them actually do bring positive returns for the S&P 500. Specifically, if we have no recession over the next 12 months, they're actually in the double digits. So we have to ask ourselves the question is this market actually showing us that kind of bullishness? You know, guys, we always look for this together. Are we seeing this right now in markets? Well, we seem to be. The other day, we spoke about the breadth in the Russell starting to improve. Of course, Tom Lee might be an absolute perma bull, but at the same time, he could be correct on the Russell 2000. It tends to do very well post rate cut cycle if we don't go into a recession. It's been 700 plus days, as you can see here on the chart, since it made a new high. And the other day on Friday, we saw with the Jackson Hole Symposium a 14-to-1 update. This is the volume of advancing stocks versus declining stocks. These are not typically what you tend to see in a market that is actually in a massive recessionary bear bust. So it brings us to this very interesting chart here posted by Seth Golden over on X. And of course, it's got to do with Tom Lee and his thoughts on Nvidia. Now, a lot of people believe where Nvidia goes, the rest of the market will. Well, is that actually a lie? Is it the truth? Well, let's have a look here together. You can see that Nvidia gave, let's say, not a great return over here, yet the market still managed to rally up. Over here, a positive return, the market sold, a positive return, the market bought, and so on and so forth. So realistically, even if Nvidia doesn't quite live up to expectations, or even if it doesn't tend to have a huge impact. In fact, the S&P 500 only has followed Nvidia 3 of the last 7 times. So I think we need to probably get rid of that concept of Nvidia is going to control the market, and instead we just need to say, did Nvidia meet the expectations, and therefore is it fairly valued or not? Well, before, of course, the earnings, we know that it was trading around 42 times. Now, you might say, well, that's too overpriced. But remember, that's within the 3-year and 5-year medians. And I'll get a 5-year chart for our weekend video, so make sure to subscribe for that. And you'll see that actually it's right on where it should be. If not, it's actually getting a little bit cheaper right now at the time of this recording because, of course, it is dropping, which makes it a little bit more exciting to actually possibly be a buy the dip style scenario. This earnings season wasn't all bad. It wasn't terrible. It wasn't great, but it pretty much met most expectations. Remember, what this earnings season has done is reiterated that the market is now starting to look towards the 493 stocks that aren't the Magnificent Seven in the S&P and the smaller caps. And we've already started to see that kind of rotate through. But one of the most important reasons why this could be the big thing for the markets over the next 12 months is because we know corporate buybacks are the biggest leader to growth in the US economy. That may be drying up soon, and this is something that we'll have to watch together over the next 6 to 12 months. We're only sitting at 8.8% of cash on hand for some of these big businesses in the S&P 500, and that means that soon they're going to shut off the corporate buybacks. We know Nvidia did a $50 billion buyback. We know that they're still going on, and we're in buyback season, but it's starting to look like buyback season won't be a thing in 2025. Certainly a concern for a lot of people out there. Here's some great data from Wayne about September's, how they tend to act. And of course, it does show you that September 23rd to September 30th, usually showing some weakness. Now, this is an interesting statistic because, of course, we know this will be around the point of the rate cut itself. And we also know that when a rate cut comes in, the market tends to usually sell off a little bit and then find its next 3-month structure. Once we've seen that next 1, 2, 3-month structure, we get a very good idea of whether we're in a recession over the next 12 months or whether we're not and which path we are following. Some things to keep in mind here, though, are whether we're in late cycle. Now, if you've been watching the channel for a while, you'll hear me talk about late cycle. I know. A lot of you in the comments down below are like, stop talking about this. But it's so important for all of us to understand that what late cycle investing means is that you'll see random defensive style assets starting to do well. Now, you may know if you've been watching the channel for a while that we've been huge gold bulls in 2024. And rightfully so. Gold is outperforming the S&P 500 at the time of this recording. And at this stage, it's starting to overtake it. And what this means is that we're probably in a period of gold and silver and some of these other metals outperformance. Now, when that happens, it's because there are issues around the world. And more importantly, it also leads into late cycle style investing concepts. So let's take a look at the market over the last 24 hours, over the last month and last 5 days to see one of the very interesting and already talked about on this channel concepts that is happening underneath the hood. So first up, clean energy, energy stocks, financials, gold, all sorts of things. They were the ones that were doing the best over the last 24 hours. Not much to really gain in terms of insight there, but if we go to the last 5 days, we'll notice that we have financials out in front. Now, how could this be? Well, at the moment, people are taking on debt. We know this because credit cards, of course, are starting to go up. We're also seeing people living their lifestyles that they probably can't afford. And now that we also see a potential of rate cuts, people are going to feel a little bit more emboldened to take more debt. Now, this is being fed into the market getting excited into financials. And if we actually take a look at the last month, you'll notice that financials have been doing okay. Of course, KRE having a nice recovery in recent weeks. But notice up here, the one that I really want to mention, not only is gold stock the number one, which is one of our favorites here, but look at the number two, one of our other favorites, utilities. Yes, utilities is doing incredibly well over the last kind of quarter. And in particular, this shows us that the market is starting to pick up defensive style assets. Now, when this happens, remember, we should always be watching this particular code. And if you don't have this one on your charts, write it down. That's consumer discretionary versus staples. What a fantastic chart to have. Everyone I know in the industry uses it, and you've got to be putting that on your charts. So this is something that we will talk about in the future because it does seem like we're in that final 1 to 2 year period. And I would estimate, and we've talked about this before, we're about 6 months into the late cycle period, which is why we're starting to see gold, which is why we're starting to see utilities run through. So let's talk last 24 hours. And that was one of those doozies that the market loves to give us when we're talking about a potential sell-off here into a gap fill. Take a look at this candle. I love these candles because they tell us so much about what's going to happen next. And more importantly, if you get trapped in the wrong side, how bad the squeeze is going to be. The market rallied up, went a little bit higher than I probably thought. In my private video I did actually for our community, links in the description down below, I talked about the idea that I thought it would get to about 56, 20, 30 area. And now that area made a lot of sense to see a sell-off. And this is exactly what it did. It went a little bit higher, got up to the call wall and the options level for the day, which I've left on the chart so you can see how great they are. And then it rejected those zones, effectively showing that someone was a seller for the session. Now, if the market continues to a new low over the next session, it's starting to kind of build upon itself. And remember, the options market gave us this prediction because the options market showed us in the 0DTEs that there were puts from about 56.10 all the way down. So many puts that were literally gamble fests from some of you out there, I'm sure, in the chat. Don't worry if you got caught. Just remember, this is what happens. And we saw it together. We knew that the market would probably hold over the last 24 hours and it would evaporate all of those puts. And that's exactly what it has done so far. So the market rallied, it sold off, and you can see this represented when we go into the smaller time frames. So in fact, what we'll do here is we'll jump into a 10-minute chart just so we can have a look at how it actually traded. It rallied through the session, got up a little bit higher than you'd think it would. I would have thought it would stop around this 56.30, and then it showed weakness here and it sold into the close. Now that's important because of course we know the market does a lot of its trading near the end and a little bit at the start, and this is showing that somebody's probably dumped a position into that. The same thing here happens here in the futures market. Now, what I've done is I've left the options high levels and low levels on for the previous session. So this bottom one here and this top one here were the previous sessions. And what you can notice is that we get selling resistance here and we get buying support here. And when we recorded the video, we were about here at that point. And of course, it made sense for us to try to drive above 56.10, which is what we managed to do. Now, because the market has now sold off this point, this could still be where bears sit in the charts. Of course, we have what we call core PCE coming, which is one of the Federal Reserve's main kind of inflation data reads. And that may be a catalyst used as an excuse. Remember, don't worry about too much about these news results. The news is a narrative. We trade the flow. We trade the price action here on the channel. But the market basically was saying, you know what? I've rejected this zone so far. So what does that tell us? Well, if the market keeps going down, then of course we have to look towards the gap fill levels. These are the two zones we had on the previous screen. If the market now takes this high, guess what? Get ready for the squeeze. The positive gamma squeeze is coming in and it will probably go quite a lot higher. Now you might say, well, that's pretty useless. We've got two situations, but you've got to remember the profoundness of especially that rejection that happened over the last 24 hours. If the market now says, ha, we're going higher, there's a lot of people caught off. And this is where I believe most trading is going. Position-based trading, fear and greed trading. This is what I teach in our courses, specifically the day trading masterclass and the advanced masterclass, which I'm telling you will blow your mind. I put like 14 years on in terms of overall experience into making that thing. But yeah, it's just phenomenal how this stuff types of works. And of course, 0DTEs is just something where you've got to become adaptive to this market. So when we look at this and we have a look at these expirations, let's just check this out for a moment. So 56.50, it seems like there's a whole bunch of calls sitting on that level. It also seems like a lot of people have entered calls over the last 24 hours trying to get it up. So it kind of opens up the idea that there could be some weakness. Now, when we go through to next week, which of course is the beginning of September, that's when you start to get these huge strikes of puts everywhere. So this is going to be a real, I'd be interested to see how that cleans up over the Friday session. But for now, it suggests that the markets will not want to be bullish above 56.50 over the next 24 hours. Doesn't mean it's impossible, but they're probably not going to want to. And there's a real possibility that the markets may try to fall back into the 55.60 range to try to expire some of these calls worthless. We'll go through that in a moment when we look at the NASDAQ, but let's also go to some of the other positions. We've got Tesla, 205, 200 puts. So we know 200 is the big put wall. We know that if the markets move underneath this, they're going to go into negative gamma environment. We also know people are stacking 210s, 215s, 220s. So again, it kind of presents that the market would make more money if we're talking about expiration to maybe sell it back down to the 205, 200. It's pretty much where we find ourselves right now. And then we come to Nvidia. Take a look at this one. Now, this is a really interesting chart because we ended up closing at 117. Quite a few people loading 120 puts. Can Nvidia find a little bit of a rally here, or is it going to go lower? Well, it did sell off 6%. We need to remember that. So it sold pretty much right in the range, plus the 2 or 3 before that the options market said. The options market said 300 billion. We moved close to, 250 billion or something in terms of the overall move. We knew 130 calls would get destroyed. That was a high likelihood. They did. You've got to remember the next week, 130 calls become the big thing again. And you'll notice there's a lot of this 115 kind of put business going on. So that will be a key level we're watching in the markets. So let's move over to the key concerns. And I think the only real key concern at the moment for markets, truly in terms of long-term horizon, is going to be the uninversion of yield curve. The US 2-year versus 10-year. It's coming back down to 1%. Once we get uninversion of yield, we're on a timer. And that means that basically the bonds market's not usually wrong. It's called for a recession for a long time. Everyone thinks it's a broken indicator. I don't tend to think it is. Do you think it is, though? Let me know in the comments down below. Remember, it has nothing to do with the inversion of the yield. It's when the uninversion happens that you need to start thinking about it. So this is obviously something that's pretty important. Let's move over to the US dollar. US dollar has been rising up a little bit. We talked about that in our previous video. We were bullish on it, obviously to this exact zone, which is where we've started to see a little bit of weakness. I still think the dollar could start to see further recovery. And one of the reasons why that is possible is because if we think about previous recoveries, we have to mark them out. We know they've been about equal in length. This has actually been a very good equalization. We had the same sell-offs that we predicted previously, and we've tended to see around the same returns. Now, what would that do? That would push us into the 20 moving average, which sits around up here. So it could be a little bit more strength in the dollar yet, something to keep in mind. Let's move over to oil. Fantastic trade. This one's fully replicable, absolute banger. A few people in our community got this. This is certainly from our day trading masterclass. And it gave you a little scare, but that's what always happens in markets. No one said it was easy to be a winner, yeah? And it got a little bit lower. I would have thought we would have stopped around 74.30. We obviously got as low as 74, but it held low, which is all that really matters. And then the market rallied back up. Now, it got through 76. So does this mean that we're going to make a new high here on oil? Well, it certainly looks that way for now. We go to the daily. The daily's held up pretty well. And you've got to put it in the perspective of the overall weeklies as well. We had this horror weekly to the downside. Then we got this massive wick back up. And then, of course, we saw this turn afterwards that. So I would say it's very neutral on the weekly. Oil has absolutely no idea what it really wants to do. But short time frame seems still quite bullish for now. Not as good, of course, the entry as we saw over the last 24 hours. But that was really nice. Congrats for people that were in that. You would have already made like 3 to 1 on your money. Let's move over to gold. Gold is very dull, very boring. We like gold, of course, longer term when we're talking 12, 16-month horizons. But this is what we call a dull market, a series of barely higher highs or just encroaching on slightly higher points with higher lows. This is the kind of market that can easily go like that, flash sell. We know CTAs, which we've been following. We'll have an update on that for the weekend video. They've been dropping off, guys. You know how I feel about gold. I love it, but I don't really love, this grind higher market. This is, of course, where you just hold your longs and you wait for opportunities. So we're, of course, at this stage looking at 24.83 to see whether that will find buyers. Now, silver did get a nice buy, and theoretically, it should actually be bullish around the zone that we're recording at right now. Now, the reason it should be, again, nothing is guaranteed. These are all statistics. You're all playing the probabilities. And I was at a conference this week, which was a shout out to anyone I met there. And it was fantastic. But at the same time, at that conference, I was talking, and one of the things I mentioned is you need around 40 reps. So whatever you're doing, whatever your system is, remember, before you have 40 replications of that exact same system, you really don't know anything about your stats. You don't know anything about your odds, and you're unlikely, and I will say this again, you're unlikely to have the confidence to hold your positions correctly. So when you see something like this on silver, it doesn't look fantastic. Obviously, you get this nice bounce up buy off here, which is good, but then it comes down again. And that's, of course, a worry. Why is it coming down again? You could argue this looks like a head and shoulders towards the downside. Sure, it could look like that. But of course, we know that this is a heavy demand zone. So for silver buyers, you want it to kind of hold around here, obviously hold this low. For silver sellers, you just want it to go underneath here. Once that happens, we open up the other positions. For now, we still love silver. Obviously, the trend is still currently bullish, so we'll see how that plays out over the next 24 hours. Copper, still holding strong, looks towards how will we react around here, looking for a weekly to close above. That'll show that metals could be the new kind of flow for Wall Street, so we'll update on that very soon. And as you can see on Tesla, it has no idea what it wants to do. Basically still 200, 205 where the puts are and the walls are for it, and it's in the middle of nowhere land. Let's move over to Nvidia. Now, Nvidia fell to what I would consider the first major level. We have an anchored VWAP. We have a 38.2 Fibonacci level, which is pretty key. We have, of course, a bunch of puts that are sitting around 115, and we sold off the correct amount. So we basically sold off what we would expect in total, about 8% down. The options market expected about 10% move. Now, did I think the Nvidia results terrible? Personally, I don't think it's terrible. I think it's pretty much in line, and a dip like this was needed. And you might say, well, it's not needed. That's stupid. Well, you've got to remember the thing went up since we talked about it 43% in like a week and a half. So we already knew based on certain indicators that we have that the market was in for sideways, what we call a pullback in time, or a dip. And that's what we're getting. We still are open to the 106 level. I would like the 106 level. I think that is a better move here for Nvidia, and you might say that's insane and scream at me on the screen, but that's what we want to see. The reason why is that it's a healthy kind of pullback in an overall trend, and it gives the opportunity for the correct type of flushes, the correct type of bigger, larger term move. So here's one of the first buy zones. Then we've got the 106. We haven't seen a strong reaction from the market just yet on it. It did open, and it opened higher, but then it sold into this area. So yeah, the futures was trading here, then it bounced, then it came back down. Interesting to see what happens here on Nvidia. Certainly looking for flow. Now, speaking of flow, this is one I've copped a bit of flack for. A lot of you guys really against this trade. And I think, what it shows us as traders and investors is leave our opinions at the door. Leave the bias that the media, and yeah, I will actually say it's crap that we see in this media, because you got to just, like, someone asked me this question, well, why don't you listen to it? Because it's written by people that are not traders, that don't have as much information that you have. You're an investor. You love this stuff. That's why you're here on the channel. We all are together. One of the things is these guys are writing this in 15 minutes and putting it out through ChatGPT or something. They don't care about your position, and they don't think about it. They're just there to put a fear-mongering, massive, big news headline in front. What has the price action shown us on HSI recently? HSI has been improving, and you can see it just had one of its best open, best run days that we've had so far since the last rally. And this just shows you that sentiment has been absolutely terrible, but we've still seen that daily 20 moving average hold. PDD came out, was terrible. A lot of people were throwing me some massive hits on that. I didn't say buy PDD. I don't care about PDD. What I care about is that we are seeing flow on this particular market. And remember, the two that we were looking at was HSI, which is just the Hang Seng, and we've also been looking at Tencent, which, by the way, doesn't exactly look like a massive piece of crap, does it, in terms of the overall stock? So this is just showing you again, time and time again, like we always say on this channel, if you want to take your trading and investing to the next level, pay attention to flow, pay attention to price, don't pay attention to the opinions in terms of what other people say to you on news articles and stuff like that, because it's noise. And noise is a waste of your time. All right, if you agree with me, comments down below, guys. I'll be reading these ones for sure. US 2000, what have we got here? Bit of weakness. We do like the US 2000. Obviously, Tom Lee loves the US 2000, but we did know that 2250 area was going to be a bit of res. It's pulled back. I'd like to see it lower. Frankly, I'd like to see it 2150. We'll see whether a buy can come in around that point, but it's still holding better than the other markets. The Dow is still actually doing really well. Record highs for the Dow. So the Dow is showing you again that 493 in play. And I know it's not 493 stocks, but it's those other things that weren't the Mag 7. That's where we're seeing the catch up. And if you have a look at an RSP chart, or you look at any of these other markets, this is where the equal weight, the other market sectors are now starting to become hotter than the Mag 7 itself. NASDAQ, bit weak here, obviously could be considered a flag. I'm sure people are drawing all sorts of patterns and things on charts. Realistically, we're looking to see whether we can get a gap fill. So one of my favorite gap levels is probably on the NASDAQ itself. and that is going to be this one here, the 462. So we want to see the 462 or the 450. That would make a lot of sense in terms of a pullback. We expected this. I'd like to see a bit more weakness before we see strength. Doesn't have to. Of course, our medium long term is still here bullish, and that's because even though everyone's calling for a recession, it's likely, based on the stats that we have here, that we're not in one just yet, even though you may disagree with that. Maybe we're in a technical one, but we're not in one according to market structure. And we must pay attention to the market structure post the cut. That's going to be one of the most important things for us to do. Be objective about it. Let's take a look at crypto. Now, this is a bit of crypto crap, I'll say that. It's not exactly what I would like to see from Bitcoin. Bitcoin came down, hit our first bull level, found a bounce, long leg doji, came up, rejected, nasty. This does open up quite a lot of opportunity. Around here is actually where I'd expect a bull to be on Bitcoin. And I see a lot of people saying, how can you even possibly be bullish on crypto? Because, you're making a series of lower highs, dude, it's the easiest thing ever. Look, to be early, you've got to understand, yes, okay, I understand. 68K plus, easy. Okay, yes, it's bullish. It's going to make a new all-time high. We've talked about that a lot. But we do still have these key little technical zones. So we've seen a rejection. We know that if the market's able to breach through 61.2 now, that's going to be huge for bulls. And let's have a look at the structure of the smaller time frame. So not shocking when you get rid of that daily. We did see a break of 63, which I thought was quite strong. The market's then sold off. I'd like to see it find some buyers. At least see some momentum past 59.7-ish. Once we see 59.7, I'd like to think that will continue to feed upon itself to the bull end, and we'll finally see Bitcoin hopefully start to recover a little bit. Ethereum's the same type of problem, except that the chart is way worse on Ethereum in terms of it just doesn't have that nice technical concept to it. Core PCE, 8:30 a.m. at New York time, guys. This is the one that's going to probably be a catalyst for whatever excuse is going on. And do remember, if you enjoyed today's show, make sure to follow us on some of our other socials. You can also check me out on LinkedIn if you're interested. And in general, follow us on X. Check out some of our courses if you want. I would say if you want to create some of the replication that we've been talking about recently, Day Trading Masterclass or the Advanced Masterclass, they're the goes. Thanks so much. We'll see you in the next one. Bye for now.